welcome to the morning panel. Hey Guy, thanks for joining. Sounds like
Hello, everyone.
tests at the airport forbid you from joining us live. So we're going to have some fun in this panel. Hopefully it'll be dynamic. Hopefully we'll create some sparks, and we'll leave some time for questions afterwards. So let's get going. It's first of all, it's really weird being at a live event, but it's actually really good to see some familiar faces that I haven't seen in a long time. So Daniel Waterhouse, Balderton, you're one of the big boys of European venture. You've been investing, I guess, not explicitly, but you have had a track record of investing in companies that have impact. As a firm, have you guys developed a specific thesis around climate, and how do you measure the impact of a company when you back it?
Yeah, no, we have. I mean, we've been fortunate to back some companies which have made a huge impact, like Small in kind of circular fashion, InFarm with Guy, who will tell us a bit more about that, I'm sure. Businesses like Small, which is doing sustainable home cleaning products and other homeware, and many others actually. And so it's been a kind of fruitful ground as an investor. And you're right, probably the early ones. I mean, Depop we invested in eight or 9 years ago. I don't think we had a big thesis around that at the time in terms of the impact on the world, but over the last few years we've got more and more thoughtful about it, and have been going deeper and deeper, and we've been working hard to understand where hopefully we can put money to work that's going to have a major impact on the world, as well as result in successful companies. And as a consequence of that, we've gone quite deep and really formulated some views around 4 or 5 areas, which are things like the intersection of fintech and sustainability. So how do we link people's investing behavior, their spending behavior in a way that encourages and rewards the planet? We've looked at obviously a lot at climate tracking, which has been a big area of investment in the industry for the last 12 months. We've been looking at other things in the food space. I mean, food is obviously a vast part of life, of the way we consume the planet, and a lot of exciting things going on there. And we've looked at the areas of waste and circularity. So quite a lot going on there. And that resulted in last year we did a huge bit of work on our own internal ESG thinking and how we would then apply that to our investment process. And that resulted in publishing our sustainable future goals, and maybe we'll get onto that a bit later in the panel. But part of that then forces us to encapsulate some deep thinking around actually all areas of ESG, and not only climate, in our investment process and our investment memos, and it's a key area which we now discuss. It doesn't mean every investment we're going to make is going to have a huge impact on climate, but it's something we're very focused on, and we see ourselves doing more investing in that, and that discipline of embedding it in the investment process, I think, helps to make that happen.
Yeah, we'll come back to that later on, and the role that our investors play in that. So Camilla, you and I share something in common. We both fired ourselves from our previous generalist VCs because we felt we wanted to have a fund that had some positive impact. So tell us a bit about your voyage and why you felt that a dedicated fund with an impact lens made sense.
Yep, definitely. So I guess we're a sort of impact fund, so we call it sort of shared value. So we're looking at companies that are building with sort of profit and purpose in parallel. So it covers both climate and then also the social side of things, so more sort of health and inclusivity. So the journey we went on was actually very much led by some of the founders we worked with early on in our career. So people like Timo at Gusto that were sort of very early thinking about sort of waste and how you could improve the food supply chain. I think that really kick-started myself and business partners John's sort of journey around thinking about this space. We set up a dedicated fund because we really felt that was how you could sort of catalyze like the full network effects of change. So I guess when we think about sort of venture all the way from our LPs through to sort of deal flow and then support, all of that is structured around trying to sort of really help our portfolio companies create the most impact at the most scale that they possibly can do. I think we've been super fortunate along that, and that's sort of something else we're going to talk about, but our LPs have really helped us with that journey, and we're hoping to sort of repay that. So our long-term ambition is that all venture firms, so if we sort of move away from this idea of being an impact venture firm to impact being integrated into sort of mainstream venture firms, as sort of Daniel mentioned, I think that is starting to happen, and we're super excited about that. We hope that that trend just sort of accelerates, and we're part of helping make that change.
And how does that integrate into your due diligence and your internal discussions when you're looking at a company?
Yeah, definitely. So I guess it starts with the sourcing. So at the sort of sourcing lens, like we're very, very disciplined around we only take conversations with companies that we think have that sort of profit and purpose mandate. Then when we go through the actual due diligence process, it's a key part of our investment committee. We use something called the impact management framework, and we do a working session with the sort of potential investment companies where we sort of hash through sort of how they're thinking about impact, which are the sort of commercial metrics that we can track that can be directly related to impact. So as an example, we've recently invested in a business that's a relationship app. One of the really interesting things there is around the sort of connection between childhood development and good relationship health. So we sort of track that as a specific metric with them. You know, in some of the climate cases, we track different things depending on what that specific business is doing. But the really core part for us is that you can link that sort of commercial metric with a very clear sort of impact metric, and then we report back to our investors on those metrics. And I guess with all things in venture, there's a lot of, you know, this is quite a new space, and so there's a lot of iteration and working really closely with both the LPs and the portfolio companies on like what is the right approach to that. So we're definitely still learning on getting that right.
That could be a whole panel itself, reporting for sustainability in venture. So you both have Big Society Capital as a limited partner. It's a foundation here in the UK with a very, very clear focus on social impact, and that's a big filter for when they back funds. So how have the LPs, the investors in your funds, influenced your thinking around climate and sustainability, and what expectations do they have on the reporting that you do back to them? I'll start with Camilla.
Yeah. So I think when we set out to set up the fund, one of the really core things to us was the LPs, and the sort of capital that was backing the fund was mission aligned. So I guess we actively went out to find those LPs that were going to sort of hold us to account on that. So I think it's very much a partnership. So we've worked with both Big Society Capital and a number of other sort of climate-focused VCs on working out what is the right way of measuring for our sort of portfolio. We've sort of decided to initially focus on using the IMP framework with them, but I think over time we will get more sophisticated on that. We're in the process of hiring somebody to lead on that, and I think over time we would hope that they work with the portfolio companies to get to sort of very detailed metrics we can report against. I guess an ongoing debate is whether you report at a portfolio level. For the minute, we've decided not to, so we report at an individual portfolio level, and we have different metrics per portfolio company, as we believe that that best represents the value that those companies are creating, rather than artificially trying to like pick one metric that we can apply across the portfolio. But that is very much a debate with them, and so far the portfolio companies have all really enjoyed that interaction with people like Big Society Capital, and have sort of engaged with them on sort of working sessions and how to sort of move the thinking forward on that.
Yeah, you know, I think you know, we had a kind of good kind of meeting of minds with Big Society Capital. You know, as I mentioned earlier, we did this huge bit of work on our ESG strategy, and which resulted in publishing our Sustainable Future Goals. And by the way, we open sourced the framework we used for doing that process. So
I know you.
Other people are interested.
Thank you.
You're welcome, and please others look at it. It's on our site. And you know, that was around the time we were having discussions about raising our last fund, and we met Big Society Capital. And so it was a good meeting of minds, because we've been thinking about a lot of this, and it kind of gelled a lot with their focus. And I think of course, you know, every LP I think wants some standard reporting, and you're expected to do your carbon tracking, etc. I would say that is hygiene. The more interesting bit is working with more progressive LPs, is actually thinking more practically about what you're doing. And again, that's why, you know, that discussion went so well, because you know, you can measure and pay lip service to all these things, but actually having practical, concrete things you're going to do to implement your strategy and make a difference is more important, which we were working on, and those, you know, dialogues with LPs like that really help us fine-tune that by getting an external perspective.
Yeah, well, we did a landscaping of funds like big and small, right? Generation, Breakthrough Energy, Bethnal Green, trying to understand how they were tracking reporting. And honest answers, everybody's rolling their own. Like everybody has their own framework of how they track impact, and then the LPs apply their own methodology. So it's a Wild West, which is why there's a working group between VCs, all of us trying to collaborate so we can work with the founders to have consistent metrics. Because if I invest at A and you invest at B and we each have different reporting metrics, I feel bad for the founders. So let's turn over to Tessa and Guy. Tessa, you just announced a 43 million round.
Yes.
We met many moons ago when you were raising your seed round.
Yep.
A lot's changed ever since. A lot's changed in the world of sustainability and impact investing. So talk a bit about your voyage and how your interactions with the investor base changed from that seed round to this mega round that you just announced.
Yeah, so it has been a voyage, 6.5 years, and still here and fighting. I think it's fair to say that sort of in our early rounds, the majority of our investors did not care about impact. They were investing for the enormous opportunity that they saw ahead for Olio. But as we've come into some of our later rounds, and more capital is coming into the impact space, we have attracted a number of impact investors onto our cap table. So I think we mustn't forget that investors are investing for a return, first and foremost, and then for many of our investors, the impact is sort of the cherry on the cake. But for some of our investors, so Rubio Ventures, for example, is our largest impact investor, that is actually, it is the cake, and they have a very, very rigorous methodology with regards to impact. But I have noticed it was something must have happened over Christmas this year. I think all of the VCs sort of woke up with a New Year's resolution list, and on there was like, we must do good in the world. Like my phone has just been sort of ringing off the hook with all these investors like, there's this thing called ESG and impact, and can you tell me a little bit about it? And I'm actually thrilled to be taking those phone calls because it encourages me and makes me believe that there is going to be a tsunami of capital coming into this space. Why? You know, I believe that there'll be no better returns than sort of saving humanity, which is what we exist to do in this space. So I think the future is very bright. There's nowhere near enough capital in the sector yet, but I'm hopeful that's going to be righted really quickly over the next couple of years.
I agree, and I mean, the big money, right? So pension funds, large banks want to deploy into the space. There's just not enough funds of scale that can absorb 30, 40, 50 million.
Correct, and that's why I'm super passionate about sort of the incubation at the beginning of the funnel, because there is no shortage of amazing impact founders. And by the way, I should say that they are, in my experience, much more diverse than typical founders. So you've got this really interesting sort of intersectionality of sort of impact investing plus diverse founders. So you've got two sort of conscious or unconscious biases multiplying one another, which is resulting in a lack of funding for early stage impact founders. And you know, we are shortchanging humanity through letting those sort of biases continue to exist. But hopefully change is afoot.
And what was the top line metric that led to this? Again, what was the top line impact metric that you were kind of showing off in this last round?
So we measure essentially sort of the number of listings that are successfully picked up, and then from that we calculate and we track sort of on a weekly basis the sort of number of car miles, for example. So I can tell you now kind of our impact data right now, we've had 25 million portions of food successfully shared, 3 million other household items all saved from the bin, and the environmental impact of that is equivalent to taking 80 million car miles off the road, and we have saved 4 billion litres of water. And we're doing 0.001% of our potential, and we've already had that incredibly profound impact.
Those are big numbers. And they're not CAC LTVs or MRRs, but they matter.
No, they do.
Guy, so where are you joining us from today?
Based in Berlin.
In Berlin.
Germany.
When you started the business, right, this crazy idea of having farming come closer to humans, did sound a bit crazy. Tell us about your own voyage as you raised the early rounds and later rounds. I mean, you raised from amazing VCs like Balderton, more generalist tech VCs in the early days, and then you brought on an impact-focused investor in the last round. How were those conversations different?
Yeah, so similar to how Tessa described it, I think at the beginning, impact or ESG in general was just not really a focus of any of our investors. And as such, the due diligence was always about financials, unit economic optimizations, and maybe most importantly, contracts and traction. And we were lucky enough to actually have that, be able to secure those first rounds, which was so critical. It was definitely not an easy voyage with 2 or 3 times of being really close to bankruptcy. And I think the change really started actually with Daniel and Boulder John sitting here and investing more significant funds and helping a lot more Infarm as a business.
Are you on the board? Are you the?
I am on the board, yes.
So it is Daniel that has the credit. Okay, fair enough. Actually, a bit of marketing for Daniel. You talk to his founders; they actually rave about him, even when things are not going well. So he's a good guy to have on your board. I just can't invest with him. We've been trying for 10 years. Guy, you said in the kind of when we were preparing for this conversation that venture capital's business model needed to change to support climate, which is a pretty strong statement. Why do you believe that?
Yeah, so I mean, quite often impact-focused companies will have a major hardware or a manufacturing component to them, and an industrial nature. And right off the bat, these companies are going to face a much steeper hill to climb, when you compare to a software company or an e-commerce company. And to me, that always seems like a gross injustice. And my statement kind of comes from there. We're facing these huge challenges, some of the biggest challenges in our brief history on this planet, and priorities need to change very quickly to tackle those. And I think VCs need to change their lens and invest perhaps more holistically. And as a general, impact companies, I believe in the short term, will actually have less revenues, lower margin. And that's something that investors, I believe, need to be a lot more comfortable with. Otherwise, we're going to lose lots of bright ideas and passionate founders, or they're going to struggle a lot more, like we have. Infarm has been existing for almost 9 years today, and we've really, after 3 or 4 years, kind of made that breakthrough into venture capital, which really, of course, helped us. That was our lifesaver. And we've been very lucky finding those right investors who are pioneering this different mindset, who are investing more holistically. And there's definitely winds of change. But yeah, I believe VCs have an incredible responsibility at their hands as the gatekeepers of incredible amounts of money that can be used for all of us at the end, for the future of this species, right? It gets as dramatic. So yeah, I believe an evolution is needed. I'm not sure a complete business model change, but definitely more patience and getting more comfortable with these new sectors.
Yeah, but to kind of unwrap that a bit, right? So I'd argue this is a kind of biased audience, but if you picked your average VC from Soho or Golden Square, impact still equals philanthropy, which might be the change of frame of mind that you're talking about. But the other point you made is about how a lot of the companies that will be climate positive are hard because they have some hardware component, or they need a bioreactor for synthetic biology, or they're deep tech companies. They're going to be in the lab for the next 2 years. So I think the challenge is they don't look like your typical SaaS MRR companies. It's not unit economics for an e-commerce business, but if it works, it has massive amounts of impact. So it might be the type of money or the type of vehicle that needs to coexist along venture that needs to change, where Bill Gates just launched this thing called Breakthrough Catalyst. All these early stage companies need that 10 million factory to prove that their science works. Nobody's going to give you that money, and it shouldn't come from equity. So Breakthrough Catalyst, I think it's $1 billion in Europe and $1.5 billion in the US, is going to fund that first bioreactor, that first factory implementation of your direct air capture. And I think that's what's lacking alongside equity for these companies to scale. And then if you have the first and second factory, then you have JP Morgan and Generate Capital and all these others that show up and give you buttloads of money for asset financing. But I think that's where it fails, deep tech and funding. So staying with the founders, what support do you wish you'd gotten from your investors along the way around the area of impact and sustainability?
Yeah, so, oh, can you hear me? Yeah. For me, there are three things, and they're all inextricably linked. So one is more capital, and actually that's sort of point 1, 2, and 3, but more capital, a greater level of comfort with risk, and a longer time horizon, patient capital. And here's kind of, from my perspective, how I see some of the challenges facing the impact investing world. So whilst impact investors are very much mission aligned with us and they really buy into our vision of the world, the reality is that they have tiny funds and they're super early in their cycle and they're trying to prove to their buddies that they haven't just lost their brains going into this impacting world. So all of that collectively means that they are super risk averse. They have got to prove and get to profitability and deliver returns as quickly as possible. And all of that means that they're not prepared to actually invest decent chunks of cash, experiment behind new and novel business models, which, let's face it, that's what we're all having to do in this space, and they haven't got the long-term time horizon. So for a company like Olio, we consider ourselves to be sort of an impact moonshot company, and we've found ourselves just falling kind of like we're between a rock and a hard place. So we've got the traditional investors who have sacks of cash but don't care about what we're doing broadly. And then we have the impact investors who are super aligned and don't have any money. And there's a massive gap in the middle, which is serious amounts of capital for impact at scale. And that's what we're all about. And that's why we have had to, because ultimately, to get to scale, you need capital. We have had to work really, really hard, find that needle in the haystack, which is the mission-aligned investor at traditional funds. And that's why, 80, 90% of our cap table is that. And actually, impact investors are a very, very small component of our cap table.
Yeah, no, it's not very known, right? But your first check was from Excel.
Yeah.
They were effectively betting on you.
Yeah.
And so, I remember when we first met, and you're like, yeah, and my Sonali just wrote me a check. I'm like, wait, Sonali did a pre-seed check in a kind of food waste. Okay, I'll take the meeting. Yeah. Guy, what about you? What do you wish your investors along the way had been able to help you with, apart from Daniel, of course?
So first of all, I completely agree with Tess, and I think that sums up very well what I meant before on that evolution VCs need to have. It's more patience, more money, etc. And on our side, what has been really useful is definitely access to cheaper debt capital. That is something, at least our business requires quite a lot. There's a lot of capex involved in setting up those vertical farms. But in addition, really access to industry partners, specifically on manufacturing, supply chain management, etc. And third one, perhaps maybe the most critical, is recruiting and really pulling the best talent from other industries into those impact sectors. And those people would probably at the beginning get a pay cut, but they will be doing better for themselves, for the world. And that's something that young companies need a lot of help with.
Has that changed? Because we were talking about it with Tessa earlier on. I have a feeling that people are literally walking out of Google, Facebook, et cetera, trying to find companies with impact. Has that changed recently?
Oh yeah, dramatically. And I think it's accelerating in the last 2 years. We definitely see that.
For you as well?
Yeah. We're recruiting right now, and I have been overwhelmed with the caliber of talent that is knocking our door down. We are punching way above our weight because people are reaching this point in their life and they're like, hang on a minute, the planet is on fire, the fate of humanity is in the balance. I think I need to sort of stand up and do something really productive with my working life. And so people are there's a massive exodus, I think, taking place.
Yeah, I think it's also the number of companies that can absorb that talent. When you're DeepMind AI, you could actually go to a company that applies AI for climate modeling. Is he somewhere in there? Or you could actually, so I think there's also places for them to go and have an impact. Yeah. So we've been skirting around this question. I think let's have a little round the table on it. Profit and purpose, or profit or purpose, can they coexist? And I'll let Camilla go first.
So I guess we clearly sort of think profit and purpose go sort of hand in hand for the next generation of companies. And a really core reason for that is exactly what Daniel and Tessa were just talking about, is talent. So I think when you really look at what sort of drives and creates these incredible companies, it is talent and access to that best quality talent really early in the journey, and being able to get people on board that you just shouldn't be able to hire. And I think as sort of ClimateTech in particular, or like the sort of, I guess the climate crisis has really come to the fore, and that's sort of going through people's lives, both from consumers and where they want to spend their time. That's allowing sort of climate companies to hire at just a rate and quality that's really unprecedented. And so we believe that's what's going to help drive companies to scale that we haven't really seen before. I think we're starting to see it in some of our early portfolio companies. So one of the companies we're involved with tracks sort of time to hire, or like average time to fill sort of senior roles. And their sort of most recent stat is less than 10 days from posting a job advert to being able to hire like incredible senior talent. So I think that's one of the most exciting things, and that's part of what's sort of driving this like ability for companies to grow with profit and purpose.
Tessa?
No great surprise. I think that purpose-driven companies will deliver outsized returns. But I get asked this question the whole time, and how I think about it is perhaps best via analogy. So back in the 80s and the 90s, people sat on a stage like this would be asked, how do you balance treating your employees well with having a successful high-growth business? You know, we've all sort of moved on beyond that conversation. We all know that they are mutually reinforcing. Treating your employees well leads to business growth. And I'd like to think that in a few years' time, we'll move on beyond this conversation, and it will just be accepted as a given.
I think it's a kind of no-brainer. I'm hugely optimistic about what's going on in every part of the climate tech ecosystem, if that's what you want to call it. The speed that capital's coming into the market, and I think the problem which you cite, Tessa, which is absolutely right, in the middle stage is lacking, will get filled fairly quickly, and it's because there's such an incredible market pull. Consumers want to find businesses, products, services which make a difference. Businesses have to, whether they want to or not, change and embrace technologies that are going to make a difference. And so the market pull is so great. I mean, if you look at Infarm, probably their biggest frustration is they can't possibly keep up with demand for their product. I mean, they've got global demand that they could be 100 times bigger if capital was infinite. And so that's going to drive a great commercial traction into lots of businesses in this space and drive profit. And I think to Tessa's point, those businesses are going to be valued more than other businesses, because the retail investor is going to put a premium on those businesses. That's going to cause institutional investors to put a premium on those businesses, and so even more capital flows in, and that creates value in itself. I think that's profound. So super bullish that there's a kind of win-win-win for the planet, for investors, and for companies over the coming years.
Let's accept it. This is a pretty biased panel, right? But Guy, what's your take? Profit or purpose?
So I think it's a very difficult question, and in a way for us a very practical day-to-day one. And I can give you an example. We sell our crops, herbs, lettuces, salads, and so on, and we have the choice to make between recycled plastic packaging and virgin plastic packaging. Now, virgin plastic is much cheaper than recycled one, but far less, almost double the CO2 footprint and all the other issues it has. So for us, choosing recycled plastic means eroding our margins and making for a worse financial projection. So the entire ecosystem, in a way, around needs to have this collective push towards more sustainable solutions. So, I believe that in those next few crucial years, it would be less profit. So I would say it's purpose over lots of profit. That's kind of how I would see it.
Do you guys do you guys track carbon costs in your P&L? So choosing the recycled plastic has a less CO2 impact. So some companies are beginning to kind of ghost track that CO2 impact in their P&L.
That's something that actually we started only in the last few months, developing this really comprehensive life cycle assessment throughout all our facilities, all of our operations. And yeah, now we do exactly that. We have a carbon cost to every decision we make. And so it's very difficult. It's very difficult.
Yeah, maybe my view is a bit more cynical, but it's like, like you said, the planet's on fire, right? We need to start acting like pretty quickly. And we don't have that much time. Like if you look at the steepness of the curve, it's in this, actually not even this decade, it's in the next couple of years that we need to take action. So companies that can actually have an impact on that curve today will carry a premium because effectively they're selling weapons into the war. So those will actually be demanded by the market, be valued better by the investors, and be valued better by the retail stock market. And that will create significant amounts of green profit and hopefully also save the planet. I do want to leave some time for questions from the audience, but let's have a quick fire around the room again. So PitchBook came out with some data recently saying that year to date, 2021, $14 billion have been invested into climate tech companies, which is 10 times the amount invested in 2011. So two quick thoughts on A, what's driving it, and B, is it greenwashing? And I'll start with Guy this time.
Yeah, I think definitely this public awareness and now starting public pressure, which is really driving all sectors in that direction, and of course, including investments. Everyone read the same news, and the expectations for investors, I think, are to do more. And when you couple that sense of urgency with really what is a potential status gain, you see this massive increase, and I would definitely expect this to continue, hopefully.
And greenwashing? Do you think there's something?
That will continue as well.
There's definitely greenwashing going on. Daniel?
Yeah, I mean, there is for sure. But I think that, in terms of where the capital's going, I think most of it is going into things which do have a long-term net positive position. But I think in the short term, there's still, we're still in kind of version 1 of what some of those companies are doing, and they need to get to kind of version 3 or 4. And for example, I think there's a lot of money has gone into carbon accounting and offsetting projects. And the reality is, I think the sophistication and transparency and accuracy of a lot of those platforms is still fairly low. Not because they don't want to do more, but because the data's not there, so the supply chain is not transparent, etc. And so some of that is selling to companies who just want to be able to publish their carbon report versus really get to the source of the truth and make a difference. But I think that the ambition of those companies is to get beyond that and to get things to a level where we really see the truth and people make an action against that. So I'm I'm definitely on the optimistic side of things. I think that a lot of capital is going into good areas, but for sure, some of it is then selling to companies which are just using it to show they're doing something versus actually doing something.
I think it's great to see 14 billion going into the sector, but I think it's a drop in the ocean and it's nowhere near where it needs to be. The reality is we have to completely retool every single aspect of our economies. And it's going to cost a lot more than 14 billion. But we must also be really mindful of sort of investor FOMO, not sort of driving bubbles within specific subsectors. And we also need to just recognise that it's not going to be kind of an up and to the right journey for the sector. There will be, I'm sure, kind of mini bubbles within subsectors as people kind of perhaps get a bit overexcited or ahead of their skis behind a particular technology or approach.
Camilla?
Yes, I 100% agree with Tessa. I think there's been a recognition that there is going to be a transition to a sort of net zero economy, and every single sector is going to get disrupted. I think you've started to see it. Like, it's a well-touted example, but Tesla's valued more than all the car manufacturers out there, and that same type of seismic shift is going to happen across sectors, which just provides a huge economic opportunity. I think the 14 billion is still only 5% of venture. So if you think about this change as being big as the technology revolution, I think in 10, 20 years' time, we might be talking about that as more being sort of 50, 60%, and that being what venture actually is. So I hope we're at the start of the revolution rather than the end.
Yep, I totally agree. It's dropped in the bucket, but it's a good sign that we even have this event happening today, right? The fact that there's a specific climate tech event at London Tech Week. We have a couple minutes left. I wanted to open it up, see if anybody had questions for our awesome panelists. Yes, sir. Is there a mic? There is a mic.
Thank you. Thank you very much for that interesting panel. So I'm Adam Durant, founder of Satavia, and we're working with airlines and leading OEMs to reduce aviation's non-CO2 climate impact. So contrails, the clouds that aircraft make actually might account for almost up to 2 times the carbon impact. So that's 3.5% overall of anthropogenic impact. 2% might come from the clouds that the aircraft make. So my question would be to the panel, what emphasis do you place on non-CO2 impacts in terms of your investments? And is that on the roadmap, if you like, for what you'll be looking at in the future?
Well, I could start. So we track CO2 equivalent at a portfolio level, but we also have like specific company impact metrics that might not necessarily be CO2 related or energy related.
I think, I mean, absolutely, and I think you'll see more of that. I mean, there is a kind of obviously a massive focus on CO2 production and impact, etc., which rightly so. It's a huge part of the planet's problems. But there's things like biodiversity, and I think that's not been that high up the agenda. And what we're doing to the surface of the planet, and how that interacts with the food supply chain, and biodiversity, which is kind of crucial for the way life evolves and works. And I think I've got the headlines. So that's something I begin to focus a bit more on.
Camille?
Yep. So we sort of track a range of metrics, and that's sort of driven by what impact the founder believes they're achieving. And so we definitely sort of look beyond CO2, even though we think that's an important metric to be tracking.
Cool. Probably any questions? Yeah.
Hello. Good morning. Thank you to the founders. I think you speak very clear. I have a question for the investors. I want to talk about adaptation. Many of the solutions that we are seeing are about mitigation,
Yep.
but there is any business behind adaptation?
So I was joking about this with a guy at Breakthrough the other day. We're all still in the rosy glass phase of we can solve this. And I think in the next fund cycle, as in the next couple of years, we'll be like, oh shit, we can't, so how do we start adapting to it? Some people already made the transition, kind of the ClimateTech original gang are beginning to look at adaptation. So we as a fund are beginning to realize that we need to start thinking about that as well. It's in case we don't fix this, what do we do? Ending on a cheery note, by the way.
Yeah, we'll fix it.
I love the sentence that we hope for the best, we work for the best, but we plan for the worst. And we appreciate if developing countries will appreciate if you also invest in adaptation.
Yeah, so right now I'm doing a deep dive thesis on cooling, which is freaking me out. Like, it's not like the Indian subcontinent is going to require air conditioning for like comfort. It will require it to live. But if India deploys 1.1 billion air conditioners with the current refrigerants and energy use, we are screwed. Mm-hmm. So it's like, they need to live, but we can't cool them with the current technology. Yeah, so that's my current adaptation deep dive. I think we have time for one more. You choose. I don't want to be. You can ask today.
Hey guys, yeah, thank you. Charlie Mercer from Codec. I lobby for startups. So I've got 2 cheeky questions to squeeze in. One is, to what extent does a carbon tax solve the profit-purpose debate? And secondly, to what extent can government help with providing a common language for measuring the impact?
Carbon tax.
I think all these things help. They provide a framework and incentives for people to change. But ultimately, I'm a believer more in consumer power, forcing companies to do the right thing, than government frameworks. But it's helpful. I think that government, or maybe not government, more independent bodies definitely need to take control of the standardization problem, because I think we talked about it earlier. There's just so many different measurements and standards and approaches. It's really hard to know whether you're looking at apples for apples when you compare things. So we have to find that standardization. I'm not sure it's a government initiative, to be honest with you. I think historically it's better that there's an independent body that does that.
Do the founders have any comments on that one?
I would actually love to see an easily accessible carbon credits market for me, because we are offsetting an enormous amount. You know, we're massively sort of carbon negative, or whatever, if you want to call it, and I can't monetize that easily, and that could be a very exciting, very robust revenue stream for me and many climate tech startups, and that would really accelerate our growth. So that would be my ask.
Yeah, it's hard to underwrite, right? Because you don't know what the price is. Is it 20 for a Brazilian rainforest? Is it 600 for a Swiss director capture giant machine? Is it verifiable? Some companies like have a line of carbon offset that gets crazy because it's like 99% gross margin, but I kind of had to discount it massively when I look at it, and it has to stand alone as a business without that, and that just becomes a massive driver on top of it. Guy, Camilla? Nope. Well, a big thank you to the panelists. Thank you, Guy, for joining from Berlin, and looking forward to the great conversations throughout the day. Thanks so much, guys.
Thanks, Christian.
Thank you.